On today's show, we're talking about shadow banks, the ticking time bomb that could affect your bank account here pretty soon. This is the American Confidant.
Loading the American Confidant intro.
We have $15 billion in gold in our treasury. We don't own an ounce.
And one of the problems is we don't have the gold. Other places have the gold.
It's called the American dream because you have to be asleep to believe it.
The American Confidant.
Good morning, everyone. Welcome to the American Confidant. And thank you, George Carlin. Thank you, Ronald Reagan. And thank you, President Trump, for that lovely intro. Today, I am Jim, and I am Jim every day. And I'm also joined with Cash in the studio. How you doing, Cash?
I'm doing great.
And also with our lovely, fearless leader, the man on the board, AAA. Trip, what do you got for us today?
How's it going there, Jim? Well, today we're talking a bit about shadow banking. Now, the shadow banking system could easily trigger the next financial crisis. Most people don't know shadow banks are not lending institutions like traditional banks. They are unregulated. They have now overthrown traditional banks as the primary source of business and consumer credit. The shadow banking industry's rapid expansion could cause serious problems if credit conditions worsen, and those loans need to be repaid right away. Now, in 2008, leading up to the financial crisis, many shadow banks offered subprime loans to borrowers with poor credit profiles, like triple B rating.
Triple B, that's like the guy out in back of your house, no clothes on, and needs to borrow a couple of bucks, right?
Something like that. They're now repeating the same pattern of behavior with another set of questionable loans that are going out. Cash has the scoop on that, how the shadow banking system can actually cause another credit bubble, and they are right now, right?
That's absolutely right. Let's talk about who shadow banks are and what they are. Shadow banks are actually, they include investment banks, mortgage lenders, money market funds, insurance companies. That's a big one.
Can a bank be a regular bank and a shadow bank and not tell anybody about it?
That's possible, isn't it, Jim?
I don't know.
Yeah, I think it is. But more specifically, hedge funds. So a lot of people invest in hedge funds, and hedge funds create derivatives. They're also part of the shadow banking system. Private equity funds are also part of it. Payday lenders. People don't realize payday lenders are also a part of the shadow banking system, and all of which are significant and growing source of credit in the economy.
So the people, the clients of shadow banking, do they tend to be willing to absorb a higher risk? Do these loans have a higher return on them?
They do, and here's the other thing. They have a higher return. Typically, shadow bankers will charge a little extra premium, so they've got a bigger spread than a regular bank. So sometimes corporations that don't necessarily have a great credit rating can go to a shadow bank, maybe a hedge fund, and raise some money that way.
These guys have cleaned up, haven't they? They have cleaned up.
Well,
I mean, since Trump was inaugurated, 40%. They've had easy markets. They've had huge spreads.
Well, you see, one of the big problems we're having right now is corporate buybacks, right? And so these corporations have taken advantage of the tax reform.
Right.
And they've used that money to come to buy back their own stock. So they've inflated stock prices through their buybacks, but they haven't necessarily put that back into infrastructure or rebuilding into their own companies.
Trump I think he was honest when he said he wants to bring that offshore money back, that at 38% corporate tax before he relaxed the tax. What did he bring it down to? What's the tax rate now, the corporate tax rate? 10%?
I'm not exactly sure, but
it's
it's quite a bit lower. But here's the thing, Jim. He created a great incentive to bring the money back. Where the whole plan fell apart or the scheme fell apart is there were no restrictions or directions on how that money should be spent.
Well,
so a lot of that money was used to buy back stocks to inflate stock prices.
And that's right, and that's where he was difficult to pivot, because when Trump was running, he said this is the worst revival since the Great Depression. The minute you raise interest rates, bad things are going to happen.
That's right.
Right?
That's exactly right.
So now all of a sudden they did that. They raised rates
for a moment.
The market goes up 40%.
Yes.
With buybacks.
That's right. That's right. So it's a hollow money. It would be different, Jim, if these companies were using that money to improve their companies, to increase their output, to develop new technologies. But they're not doing that. They're pumping it into stock valuations to please Wall Street, to please investors. But there's nothing underneath it. It's hollow.
But really what they're doing is it seems as if they're offsetting the loan price, right? So if they're borrowing $100 billion at 3.25%, they just have to outdo that, right?
That's exactly right. So it's all, this is a Wall Street dance. It's always, corporate stock has always been a Wall Street dance. It's to keep the investors happy.
So now, if they are loaning to these triple B rated, the guy in the back,
the dude in the alley, right?
Yeah, the dude in the alley. If they're loaning money to this guy, now this guy takes in $100 billion. They loan it to him at 6%. They took out a loan for 3.25%. He did nothing with the money, so he has no assets. But now the big financial institution needs to call in the money that it's owed.
That's right. He ran to the liquor store, bought some more booze, but he didn't put any clothes on his ass. So
Good Lord.
Because he did not reinvest into his company, he has no assets, and now we've got the entire world upside down.
That's exactly right.
So that's the threat that we're really talking about. Now, when we look at like things, these closed-door meetings that are happening with Treasury Secretary Mnuchin, he did one on Christmas Eve, which is an emergency phone call to all of the top banks to assure that there was liquidity in the market. And now, last Thursday, there was another secret meeting to discuss the corporate debt time bomb that's ticking right now.
It's the very same thing that he called about in December, right? Just before the markets tumbled. Do you remember in December, it's just Christmas Eve. I'll never forget it. The markets almost collapsed on
Christmas Eve.
Merry Christmas, Jim.
Ho, ho, ho.
Yeah, that's right.
I mean, that's amazing, that the American people on Christmas Eve, man.
Well,
what
they were
was it,
asleep.
1,100 points?
Nobody's thinking about the markets, but Steve Mnuchin makes a secret phone call, and because it reverberated to Wall Street, and suddenly the next day the markets are almost.
You know what? We're an abused partner.
Absolutely.
We're getting smacked around, but then we get kissed. Then we get smacked and beaten. Then we get kissed, and then pretty soon, I'm like some battered wife. Really, that's what I feel like. I feel like a battered wife.
Well, wait till the divorce comes, Jim, because not only will you be battered, but you're going to be broke.
Now, you made you told me a note about Steve Mnuchin and a bit about his background. What was that about Goldman Sachs?
Yeah, Steve Mnuchin, he's the Treasury Secretary, Steve Mnuchin. He's a former Goldman Sachs investment banker who eventually made more than $10 million buying and selling with his partners a California bank that, after engaging in aggressive mortgage lending, failed during the last housing crisis.
Wait.
That was IndyMac Bank.
Wait, so the Treasury Secretary, or current one, Steve Mnuchin,
yes,
made $10 million profiting from selling people who couldn't pay their bill mortgages that they couldn't afford, and he ran off with $10 million?
That's exactly right.
Wow.
Now, this was before the FDIC reform, so keep in mind that IndyMac Bank was a commercial bank. So a lot of business people had their money there. At the time, the FDIC only insured your deposits up to $100,000. A lot of people got wiped out during that downturn. They reformed the rules after that, and now you're insured up to $250,000. The problem is that the FDIC insures banks at the highest level. So before the depositors actually are insured, the A stockholders are insured on top of them. So they're the ones who get the money first.
Cash, you've been talking about secured investors.
Yes.
As opposed to non-secured investor. So I hear that Warren Buffett is buying bank stock. Yes. I hear he's buying a ton of it. And I think, well, that must mean that I should buy some bank stock. Is there a problem with that?
That's a great example, Jim, because you buying bank stock and Warren Buffett buying bank stock are two different things.
What do you mean? It's the same stock, right?
You both approach the bank. Warren goes in the door on the left. You go in the door on the right.
Okay.
Now, he's in the executive lobby. You're in the teller line.
Okay.
He gets A shares of the bank and preferred stock.
Preferred
stock, which means that he's a secured creditor.
Secured.
So if the bank fails, he gets his money.
From who?
Jim, directly from the resolution of the bank.
Is that where it comes to my side of the line?
No. Unfortunately, Jim, you don't get the same payout.
I don't get the same payout.
You're a common shareholder.
I'm a common shareholder.
Which means that you are an unsecured creditor. So as the bank folds, Warren gets paid, you do not.
Then how come, Warren's out there telling me to go out and buy that stock and saying what a good idea it is to invest in the banks right now?
Well, it is a great idea if you're Warren Buffett. It's not such a great idea if you happen to be Jim LaFave.
You mean the miracle, the sage of Omaha, Doesn't have my best interests at heart? Wow.
Unfortunately
Okay,
not.
let's continue. I'm a little sad, but let's keep going if I can.
You know, Jim, I think this is an important point because many people look at Warren Buffett and they follow Berkshire Hathaway and their investment style and everything else. But again, you know, we live in a duplicity system. So there's you and there's them. There's us and them. You know, them being the ones, the wealthy, the people, the haves, the ones that hold all the cards, and then the rest of us. You know, us poor working stiffs. We don't get paid out at the same rate of pay. We don't get the same treatment. Unfortunately, we get the common stocks.
So while we're on this subject of Warren Buffett, one of his darling banks, Wells Fargo, what's the difference between Wells Fargo and a shadow bank like Quicken Loans?
Well, Wells Fargo is just a violator. Wells Fargo does have regulations, so they do come under traditional banking regulations, which have been tightened up since the last financial crisis. So they're under more scrutiny than the shadow banks. Shadow banks have a lot of leeway. They're unregulated. Well, I won't say entirely unregulated, but they don't have the same stringent guidelines that the traditional banks do, like Wells Fargo. Wells Fargo just happens to be a major violator. So they're the mea culpa bank of all banks.
Right.
A violator.
So if Wells Fargo was a shadow bank, do you think they would have filed BK and been wrapped up already? Or what's your thoughts on that, hypothetically?
It's a difficult question because a lot of these shadow banks, you know, because they operate in the shadows, as the name implies, they have a lot more flexibility. They're not held to a higher standard like traditional banks. And so if Wells Fargo was a shadow bank, maybe they could get away with even more than what they're doing now. That's a possibility.
So I'm curious, Jim. Well, why do you think that they're having secret meetings at the highest level right now? Secretary Mnuchin sitting down, talking about corporate debt, how it's about to affect the American people, and what they can actually do about it. Why is that happening right now?
Why it's happening? I don't know. I don't even know if it's happening. I don't know what these guys are doing. Maybe they put out a little note that says what they're doing, and then they're sitting there laughing at us constantly. I don't trust anything. I don't trust them. I don't trust Mnuchin. I don't trust any of these guys, these politicians. It's insanity. You can't, and really, literally, it's to make us forget common sense, make us forget 2 + 2 is 4. I've been sitting here listening to this stuff all morning, guys, and I got to tell you, all I think, I see red. I'm getting madder and madder because this is harder for me to grasp and understand. I'm starting to realize that it doesn't need to be.
Well, here's one of the big
This
problems.
system needs to be a lot simpler, man. It's like you go out and make a buck, you get paid, you go out and spend it on your family, and you all grow and you have a happy community. How did we get to this point? My God, shadow banking? All the banks are shadows. I don't know what they're doing. I don't know how much money's in the account. I can't go there and look in the vault. I mean, I can't get my money out now without a suspicious activity report. I mean, come on. It's not even my money.
Not anymore.
Do they even have my money?
That's a big question, isn't it?
A huge question. Now, with the involvement of the Dodd-Frank Reform Act and things like orderly liquidation authority, this becomes more of a violation to you, Jim, because you, as an unsecured creditor of the bank, of the financial institution, if the bank goes through financial hard times, they have economic volatility, the stock is dropping dramatically, they can freeze your money and they can convert it into shares of equity of their failing institution.
That making sure that Warren doesn't lose any money. Warren
That's
Buffett.
exactly right. Here's the big trigger. This is where it really comes home for the average guys like you and I. And it comes right down to this, Jim, that we don't know how these banks have invested their money. One of the things we do know is that shadow banks oftentimes, not only do they go to large institutional money, such as hedge funds, pension plans, retirement accounts, annuities, insurance companies, but they also take that money and they'll loan the institutions, the big institutions, the traditional banks will loan it out to some of these shadow banks. Well, these shadow banks are the risky banks. They're the ones that are creating the derivatives, the bubble markets outside of the traditional banking system. If one of them fails, and suddenly this traditional bank that you bank with, Wells Fargo, Bank of America, Chase, it doesn't matter, the big banks, if one of their shadow banks customers fails, it could trigger a whole chain of events that can bring down that big institution. And suddenly, the orderly liquidation authority comes into effect.
So all Wells Fargo really has to do is outsource all of their bloodhounds, all of their henchmen, all of their people who have been working for them, who got them into all this trouble, to somebody like Quicken Loans, to somebody like Loan Builder, to somebody like any of these institutions, and now they can keep their system going business as usual, while Warren Buffett sits back and knows that his ace up the sleeve is, if this all falls apart, he's got preferred shares and he's got orderly liquidation authority.
Oh, that's right. And it goes even worse. It becomes even a bigger problem than that.
Wait a minute. Let me ask you a quick question here. Me as an investor, like say I've got money, can I buy preferred shares?
Depends on how much money you have.
Does it take a whole lot of money to buy a preferred share?
It could. It depends on the company.
Really?
And where they set the level.
So my 401k, my IRA, typically, if I'm in that.
You're in common shares, Jim.
Common shares. So even so if I call my financial planner and I say, am I in common shares? And he's going to go, no, they're really good shares.
Your shares are common.
Oh.
When you buy on your trading platform, or when you put your money into your mutual fund, that's common shares. The institution itself has preferred shares.
It's interesting because John Williams, and we were talking to him yesterday, he was talking about that the S&P since the beginning of this century, right, has not outperformed gold.
Not at all.
Because of the tweaked numbers, because they've screwed with the numbers.
Well, we know that they no longer, beginning with the
Let
Clinton
me ask you this. In
administration.
2008, Cash, when the market crashed, right, did the preferred holders of stock lose like common people?
No, not to the same degree that common people. The average investor lost 40 to 70% of their net worth.
Okay.
The average investor. Now,
Right.
preferred shareholders were made whole. Very few of them lost money. And they could be your neighbor next door, depending on how they've allocated their portfolio.
So say I had Lehman Brothers shares when Lehman Brothers
you're
went
done.
down.
You're done.
But
Lehman
if I had
Brothers-
preferred shares,
No, Lehman Brothers went under. They became totally insolvent.
So
they
even
were
if-
absorbed. So that's a good question because it's much like what we're being set up for right now. Because at the end of the day, Jim, here's what happens under the new structure. Because in 2008, the financial systems weren't prepared for the collapse the way it unfolded.
Mm-hmm.
But right now, what we're faced with is if we go down that path again, there's already a plan in place. And we've uncovered secret documents directly between the Bank of England and our own FDIC, Federal Deposit Insurance Corporation.
we've
Uncovered the documents. And what those documents say
right.
is if there is a failure, a systemic failure of one of these globally, systemically important institutions, CFIs, if those banks fail, you as a common shareholder or a depositor in the bank become a common shareholder. So your money, by virtue of deposit into that institution, will grant you authority to become a shareholder.
What'd you call that, those banks?
They're CFIs, significantly important financial institutions.
Sounded like feces. I'm sorry.
It's
Go
similar,
ahead.
but they're very close.
So,
But
right.
nonetheless, Jim, here's the problem that we have today. If there's a collapse, you will be issued shares for your money that's on deposit. Your money will be separated from your shares, so that money will get transferred to a new bridge company that will be fully funded by all of the depositors in that institution. This is the new formula.
Wow.
So your money, you'll get shares.
Uh-huh.
Your money will go to a new bridge company.
Uh-huh.
That new bridge company will be a brand new company fully funded by your deposits. And at the end of the day, Jim, they don't expect, after all the liquidation and resolutions taking place, they do not anticipate you to be made whole. In fact, they've spelled it out very clearly in this document that
Wait a
we've
minute.
uncovered.
Where's my wallet right now? I need to go find my wallet.
Your wallet may be empty. By the time
Well-
this is done, your wallet will be empty.
Say that's where they get into the boring, the bridge part of this. I mean, all that stuff, it just puts you to sleep. It's not
That's
something
it.
that you want to read.
Right.
And then they bury it in these
they're counting on
And
that.
so I don't understand a
right.
word of this, right? And so then I think I'm ignorant, and so then I got to trust these institutions to make the right decisions with my money. Is that pretty much it?
That's it. They do it on purpose. You have things like CFI. You have things like adequacy of loss absorbing capacity of
What does
globally
that mean?
systemically important resolution.
Systemically,
It puts you to sleep. It makes you not read past the headline.
I must not really understand
But-
it. Well, they must be right.
if you understand right now that orderly liquidation authority can take 50% of your money and convert it into equity shares, you need to be outraged right now.
Half, ladies and gentlemen, half your cash.
You just divorced the banking system.
You know what happened, Jim? In 2008, the American public woke up. They were wide awake. They were buying gold. You had people like Glenn Beck, who was a champion for gold and silver and alternative currencies. So that market was running away from the U.S. government. They were losing control. The head of the Bank of England issued an edict at that time that said rising commodity prices defy our position that we have inflation under control. He says we need to grab this bull by the horns, take charge of the commodities market through the futures and options market, and bring the price of gold under control. And that took place in 2010.
Well,
Immediately, there was a brand new market that was created to allow the Wall Street bankers to trade gold and silver 24 hours a day. Jim, this time around, it's going to be different. They're regulating the prices of metals right now. We know that. We know that J.P. Morgan, Fidelity Bank, the Chinese are all regulating the price of silver. But what's been happening since then? Central banks have been buying record amounts of gold. And why are they doing that? Because ultimately they know that when the markets collapse, the price of gold, according to the Basel III Accord, will rise 1-to-1 with the U.S. dollar.
And
it's
then
priced.
at that point, it's us against them.
That's right. That's right.
It's us against them. Today, we were looking at the gold market rising sharply on Mideast tensions. Gold rose sharply in overseas markets last night as Secretary Mike Pompeo blamed Iran for the tanker attacks in the Gulf of Oman. Did I say that correct?
That's right.
Okay. The strength carried over to the COMEX open in the New York market. Now we're up $13.50 an ounce on gold, up $5.50 after being up $9 yesterday.
And the stock market's up again today, isn't it?
Well, I don't know where the stock market is because I don't pay attention to that any longer, Cash.
Well, here's the thing, and I do. And the reason that I pay attention to the stock market and the gold prices rising at the same time
That's key.
Because the stock price is where the hot money's going into.
Yeah.
But the gold price is rising on investor demand. Typically, gold prices rise as the stock or decline as the stock market declines.
Right.
The real indicator of the price of precious metals, gold in specific, is tied to the dollar. So the strength of the dollar. Now, we also have the dollar rising as well. In the last 2 days, the dollar's getting stronger.
And gold also.
Gold's getting stronger, which is an anomaly, isn't it?
Isn't it? And, you know, this is where I'm seeing also whenever I see the stock market up, I don't even have, at these days, I don't even have to look at the gold and silver price. I know they're up. And this is because anything to drive this market up, it's going to take cheap cash. It's going to take buybacks. Cheap cash, it's physics, mean higher gold and silver prices.
That's right. It's very unusual for gold as well as the dollar to rise at the same time. That's a pure investor demand. Mm-hmm. That's what's fueling this price. And we have that right now. We've had it for the past 2 weeks.
You know what it is? It's the dollar's rising because we've been kidnapped and we're being force-fed the dollar. Gold's rising because that's what we need to have to back us up. Once this stuff starts to gurgle in our stomach and we got to puke it out.
Any of this information that you guys might want in regards to GC fees, the secret document that Cash mentioned, which is the Bank of England and the FDIC, give us a call, 800-474-9159. We'll be glad to get that information right on over to you. And that's all we've got today for the American Confidant. We'll talk to you next time.
Well, she's passionately lean, and she's passionately lame. We in America, we gonna get down funky like a bow-legged monkey.